Okay, dear student, let's just quickly discuss pre-scene mock June 25. Today we'll be discussing section A and then tomorrow section B and the day after tomorrow section C. Which companies are within Brownies Limited chargeable gains group? Basically, in capital gain group, direct holding of parent we need 75%, and from one level to another level we need holding 75%, and then effective holding of parent must be more than 50%. But direct holding has to be 75. After that, at each level, it has to be 75. Then finally, effective has to be more than 50. Brownie Limited owns 95% of ordinary share capital of Cookie. Brownie owns 95% share capital of Cookie. So obviously both are coming in the 75% capital gain group. Cookie owns 100% ordinary share capital of BC. 100% ordinary share capital of BC. Brownie is having 100% holding in BC. Okay, now Cookie Limited owns 75% ordinary share capital of Donut. Cookie has got 75% ordinary share capital of Donut. Then BC is having 58% ordinary share capital. This is the group. BC is having 58% holding of Wafer. So obviously Wafer is not a part of 75% capital gain group. Fine. Now, Brownie has got 95% ordinary share capital in Cookie. So obviously, Cookie is a part of 75% capital gain group. Okay. And 100% ordinary share capital of BC. So BC is also part of 75% capital gain group. Okay. Now, check this. Brownie has got 95% holding in Cookie. And Cookie owns 75% ordinary share capital in Donut. Now, if we check effective holding of Brownie, it is coming more than 50. What was that? 71.25. Okay. So since Brownie is having holding more than 50%, so Donut will also come within this 75% capital gain group. Now let's find out the choices. Which one is the correct? The question is how? Actually, in a 75% capital gain group, your direct holding has to be 75. At each level, it has to be 75. And then your effective holding more than 50%. From Brownie to Cookie, the holding is 95%. From Cookie to Donut, the holding is 75. And when we check the Brownie's holding, effective holding in Donut, it is coming more than 50%. So that is why it is also a part of 75% capital gain group. So let's check which companies within. Now this is important. Which companies within Brownie's limited chargeable gain groups? So can I say with Brownie, BC is coming, Cookies coming, Donut is coming. Read the requirement. Which companies are within Brownie limited chargeable gain group? So with Brownie, Cookies coming, Donut is coming, and BC is coming. Let's see the option. Option alpha, A, BC, Cookie, and Donut. They all are coming with Brownie's chargeable gains group. Is this clear? The question being asked is, they're not asking how many members are within the 75% capital gain group. They are asking how many companies they are coming with a chargeable gain group with Brownie Limited. So the ultimate parent is Brownie. For Brownie, we have to work. So with Brownie, BC, Cookie, and Donut. Okay. Indicate by clicking on the relevant boxes in the table below which of the following actions HMRC can take in order to collect actually tax owing in respect of Drake's unfiled return. Drake started a new sole trader business. He then received a notice from HMRC to submit his self-assessment tax return for the first tax year. He did not submit the return by due date and still has not submitted. Now what to do? Which one is correct? Start a compliance check inquiry to in the return. That's false. Basically, the correct one is make the determination. Now HMRC will decide how much tax you need to pay. Offer an internal review, raise this. Basically, rest of all three, why they are incorrect? Basically, they depends on someone has submitted the return and something is wrong with the return. Then these issues will arise. But right now, he did not pay the tax. He did not submit the return at all. So make a determination. How much interest will firms owe HMRC in connection with the second payment on account for tax year 24-25? Actually, what happens that 50% of the relevant amount is your income tax liability, less pay at class 4 NIC. Whatever comes the relevant amount in the previous year, 50% of that is paid on 31st January during the tax year. Then second payment on account is on 31st July after the tax year, and the final payment is made on 31st January after the end of the tax year. But if the sole trader thinks that in the future my income tax liability will reduce, then you can ask HMRC to reduce your payment on account. But make sure then your income tax liability should reduce, because if your income tax liability does not reduce and you have paid the reduced amount as payment on account, obviously then you have to pay the difference with the interest. Let's see what happens here, how much interest Thoms is required to pay. Thoms has been running his sole trader business for many years. He had an income tax in class for NIC liability for the tax year 23-24, 23,400. 23,400 means you've normally for tax year 24-25. First payment on account will be on 31st January during the tax year. Second payment on account will be on 31st July after the end of the tax year. Then your final payment, or you can say the balancing payment, will be on 31st January after the end of the tax year. Okay. Thoms believed that his trade would experience a slump in the tax year 24-25, so he made a claim to reduce the second payment on account 24-25 to 10,000. It means first payment on account he has made 50% of that. Because we pay 50% of the relevant amount as payment on account. So 23,400, if I take 50% of that, it means 11,700. This was his first payment on account. Second payment on account, he has reduced to 10,000. Okay, now he made his reduced payment on 31st July 25. Tom's income tax and class for NIC liability for the tax year 24-25 actually ended up being 14,300. Any balance remaining due on 30. Now listen carefully. Basically, what happens on the final payment date, we take your income tax plus class 4 NIC. And from this, we deduct your payment on account, which is 11,700 and 10,000. Whatever comes, that balance is paid. Now, try to understand what is happening. Your actual liability is very low. It's only 14,300. So Thoms has actually already paid more than his income tax liability in class for NIC for 24-25. So logically, Thoms is not required to pay any interest on this, on his second payment on account. Why? Because he has already paid more than that. If income tax in class for NIC would have been more than, let's say, more than whatever Thoms has paid, then the issue of interest would have come. But right now, actually, your 24-25 income tax liability in class for NIC is less than what you have already paid. That is why no interest at all. So interest must be 0. What is the index cost? If you recall, index cost means cost plus indexation allowance. Cost plus indexation allowance. Cost plus indexation allowance. Okay. And we know that issue of indexation allowance only arises when you bought chargeable assets before December 17. No matter whenever you are selling it, the main concept is if you bought the chargeable asset before December 17, then indexation allowance issue will come. If you're selling it after December 17, then indexation allowance will come till December 17. After December 17, there is no indexation allowance. If company has bought any chargeable asset after December 17, then indexation allowance issue will not arise. Now, examiner is asking us, what is the index cost that should be deducted in calculating chargeable gain on the sale of shares on 17 September 2024? Examiner is not asking us to calculate capital. He's asking us what index cost will you deduct? What index cost will you deduct on the disposal of shares on 17 September 2024? Let's see. McGill Motors Limited has made the following purchases and disposal in Presstown Pylons PLC over the years. Purchase 1st June 2022, that is why indexation allowance will come. 40,000 shares, they were bought for 50,000. It says cost of proceeds. Then there's a simply disposal on 17 December 2024. 12,000 shares are sold for 97. Actually, we need to find out what is the index cost of 12,000 shares. There's a relevant indexation allowance 0.578. Now look at this. We have a cost of 55,000. Let's add simply indexation allowance. 55,000 into 0.578. That gives us the indexation allowance. 55,000 to 0.578. I'm getting 31,790. Here comes the index cost. index cost is 86,790. But this is the index cost for 40,000 shares. How many shares we are selling? 12,000. So index cost of 12,000 shares is equal to 86,790 is the index cost of 40,000 shares. We need to find out the index cost of 12,000 shares. So 86,790 divided by 40 will give us in average index cost per share. We are selling how many shares? 12,000. So I'm getting the answer 26,037. This is the index cost of 12,000 shares. And option C. What is Brandeis capital gain arising on the sale of antique vase? Brandeis sold an antique vase October 24. Net proceed is 7,800 after deducting selling cost 1,700. She had originally purchased the vase. Actually, here we have to use the special 6,000 rule of chattels. Now, what is happening? Your net proceed is 7,800 less the cost 5,350. This is a capital gain. 7,800, which is the net proceed after deducting 1,700, 5,350. The capital gain is 2,450. When you bought a chattel for less than 6 and you sold it for more than 6, first you have to calculate a normal capital gain. Okay, you have calculated. Then I have to compare this capital gain with the formula. Formula is 5 upon 3 gross into bracket gross proceed minus 6,000. So by using that formula, whichever gives us a lower capital gain, that will be your answer. What is happening? We bought it for less than 6. We are selling it for more than 6. In that case, we have to compare this gain with 5 upon 3 into gross proceed. Gross proceed means you are not supposed to deduct selling cost. So 7,800 plus 1,700. 9,500 minus 6,000. Let's see what we are getting. 9,500 minus 6,000. 5 upon 3. I'm getting 5,833. So whichever is lower, that is your capital gain. Whichever is lower. So I'll go for this. So this is the special rule. If you go back and just recall the special rule of 6,000. So whenever you are buying a chattel for less than 6, selling it for more than 6, then first you have to calculate the normal capital gain, and that will be compared with the formula. Formula is 5 upon 3 gross proceed minus 6,000. Whichever method gives you the lower capital gain, that is your answer. Okay. Garrett made a VAT inclusive standard rated supply. VAT inclusive means including VAT. VAT inclusive means including VAT. On December 2024 for a consideration of 2,850. Select the correct values for this. VAT element. Now listen. 2,850 is inclusive of VAT. Basically, whatever is your price, that is, let's say 100%, you will add the standard VAT, which is 20%. So logically, inclusive of VAT value becomes 120%. So how to calculate the VAT element? 20 upon 120 or 2,850 1 upon 6. This is how we calculate VAT element from the VAT inclusive price. So the VAT element is 475. The value of the supply is 2,850 minus 475. 2,850 minus 75. 2375. So logically here you will be getting the right answer 475, 2375. Okay. Which of the following is statement about tax return? Look at this. They're not asking which one is correct. They're asking which one is incorrect. Which of the following statements about tax return is incorrect? Okay. A tax return comprises a main return form, yes, together with the supplementary pages for a particular source of income. This is true, but that's not the answer. We need to find out incorrect. A partnership must file a separate return and account for each partner's tax on his return. False. Partnership is going to file a return, but the point is, in that return, partnership will just disclose HMRC how much profit actually belongs to each partner. Then it is the responsibility of each partner to separately submit their returns, not the partnership. So second is false. If HMRC calculates tax for the taxpayer, it merely does so based on the information provided, does not judge accuracy. That's also true. If HMRC calculates the tax for the taxpayer, it merely does so based on the information provided, then they does not judge accuracy of it. That's true. HMRC is doing it for you. An employee who has employment income with tax collected underpay is not required. Normally, if you are an employee, your tax is normally paid underpay. So no need to do anything. So basically the answer is this one. Beta. Great. What is the early time limited corporation tax liability for the year ended December 2025? For the year ended 31st March 2025, early time limited has taxable total profit like 20,000. The company also receives dividend of 13,000 non-associated companies during the year. It means your taxable total profit is 220. We will add non-associated company means where your holding is less than or equal to 50%. It's not exceeding 50 because if it exceeds 50, then company becomes your associated company. So it's non-associated. Add dividend from non-associated companies, which is 13,000. Here comes your augmented profit, 2,33,000. Logically, the lower limit of augmented profit is 50. Upper limit of augmented profit is 250. Here, your augmented profit lies between these two limits. So it is more than 50,000, it's less than 250. Corporation tax rate will be the main rate, which is 25%. But in addition to that, you will get the marginal relief. Marginal relief is only available when your augmented profit is more than the lower limit and less than the upper limit. And we know that corporation tax rate is applicable on taxable total profit. So 2,20,000 into 25%. 2,20,000 into 25%, I'm getting 55,000. Less the marginal relief, augmented profit, upper limit 2,50,000, minus the augmented profit, which is in the question. Standard fraction 3/200 multiplied by taxable total profit, which is 220, divided by augmented profit, which is 2,33,000. This will be your final corporation tax liability. Let's use the calculator. 2,50,000 minus 2,33,000. 3/200, which is the standard fraction, then 220/233. I'm getting 240.77, so make it 241. 55,000 minus 241. 54,759. 54,759. Okay. Margin relief is very simple. The issue of margin relief will only arise when your augmented profit is more than a lower limit is 50, and less than upper limit is 250. If your augmented profit falls between these two limits, only then the margin relief comes. The formula of the margin relief is 250 minus the augmented profit in the question. This is standard fraction 3 upon 200. Taxable total profit in the question, augmented profit in the question. Okay, now. Which of them is our resident in the UK for the tax year 24-25? Now, just before doing this, just a minute. Okay, that's great. Just come here. Residency. This is very important. We have discussed this before as well many times. Check automatic non-UK residence. If satisfy one test, then non-UK resident. So first you need to check non-UK residence tests. Even satisfy one test of non-UK resident, then it becomes non-UK resident. If it is not satisfying non-UK residence test, then go for step 2. Check automatic UK residence. If satisfy one test, becomes UK resident. If it does not satisfy automatic residence test, then go for step 3. Determine how many sufficient ties with the UK exist and how many days spend everything. Okay, now. The order of the procedure is important because it is possible for an individual to satisfy both one of the automatic and non-UK residence tests and one of the automatic UK residence tests. This is very important. If this is the case, the non-UK resident test takes priority and the decision is made step 1. There is no need to continue with the step 2. Student, this is extremely important. If you come across a question where same individual is meeting automatic non-UK resident test as well as automatic UK resident test, assuming both the tests are satisfied. Repeat. If you come across a question where one individual is passing automatic non-UK resident test as well as automatic UK resident test, then according to HMRC, the priority is given to the step 1. We will consider that individual as non-UK resident. Repeat, if an individual is passing automatic non-UK resident test as well as automatic UK resident test, so we'll give priority to the step 1, and step 1 says treat that person as a non-UK resident. Now come here. Automatic non-UK residence test. An individual is automatically not UK resident if individual is in the UK in the tax year for less than 16 days or 46 days has not been UK resident in any of the previous 3 tax years. 91 days and works full-time overseas. If any one of them is met, the person is automatically non-UK resident. Now, automatic UK resident. This is very important. An individual is automatically UK resident if the individual is in UK for at least how many days? 183 days, becomes automatically UK resident. The individual only home is in UK. If someone is having only home in UK, that person will also become automatic UK resident. The individual works full-time in the UK. So someone is working full-time in the UK, that person also becomes automatically UK resident. Now, another very important point. We have done this so many times, so I'm just going for a main point. Come here. Not previously resident. Just focus on this, not previously resident. Days in UK, less than 16 days, automatically not resident. Look at this. If the days are coming between 16 to 45, if the days are coming between 16 to 45, automatically not resident. We have just discussed if a person meets automatically not resident test as well as automatically resident test, priority will be given to the step 1 and that person will be treated as not resident. So someone is not a previously UK resident person, number 1, spends 16 to 45 days within UK, that person is automatically treated as not resident. If someone is automatically considered as not resident, then no matter that person is passing automatic residence test, still that person will be treated as not resident. Step 1 is given priority on step 2. Just keep that in your mind. Now come here. Which of them are resident in the UK for tax year 24-25? Hansel and Gretel arrived in the UK during the tax year 24-25. Neither had previously been resident. They were not resident previously in the UK and then work in the UK during the tax year 24-25. Remember, they were not previously resident. In July 24, they each acquired separate homes in the UK. Neither of them is having any other home. It means that, come here. Automatic UK residence says the individual only home is in UK. On the basis of only home is in UK, it looks both are UK resident. But wait. In the tax year 24-25, Gretel spent how many days? 39 days in the UK. Stop. How many days? 39. No. Just a minute. Where is that? Okay, come here. How many days he has spent? 39. Don't forget that. Come here. Someone not previously resident is spending between 16 to 45 days, automatically not resident. Even though he's having the only home in UK, which meets automatic residence test, but he has spent only how many days? 39 days. Just spending 39 days previously he was not UK resident, that makes him automatically not resident. And we have discussed, if a person meets both the test, then step 1 is given priority, that person will be treated as not resident. Even though he's having a home, only home. So Gretel is not resident. Because he's meeting both the tests, automatically resident as well as automatically not resident. So we'll follow the automatically not resident. Hansel spends 66 days. When you are spending 66 days, that they are more than 45. So you are not automatically not resident. Hansel, due to spending 66 days, is not falling as not resident, because if you come here, Hansel is falling somewhere here, 46 to 90 days. So then how many ties leave there? The point is, if you're spending 66 days in the UK, then automatically you are not UK resident. Automatically, I cannot say you are not UK resident, because at least you are not directly passing not resident test. You're not automatically not resident. Now, since you have got a only home in the UK, you have passed the automatic residence test, so we'll follow that. So only Hansel is UK resident. So always remember one point, when one individual passes 2 tests, automatic not resident, automatic resident, then we will follow automatic non-resident. By which date must BFD file its corporation tax self-assessment tax return for 15 months period ended 31st March 25. Basically, return is submitted 12 months after the end of your period of account. Repeat, 12 months after the end of period of account. BFD Limited decided to change its accounting date, so had a 15 months ended March 2025. Basically, we know that you will split that 15 months into 12 and 3. No, that's talking about the return. Must file limited corporation as self-assessment tax return. They're not saying, it's not a tax payment date is different, return is different. Payment date is, if you are not a large company, then 9 months and 1 day after the end of your account chargeable accounting period. If you are a large company, then pay corporation tax and 4 equal installment. They're talking about self-assessment tax return. We know that 15 months period is divided into 12 months chargeable accounting period and 3 months chargeable accounting period. But your self-assessment tax return is submitted 12 months after the end of your period of account. So 12 months. 31st March 2026. You are going to submit 2 returns, but both the returns will have the same date. Because the rule says you will be submitting a return 12 months after the end of your period of account. So there will be 2 returns, one for the December 24, 12 months period, one 3 months, 31st March 25. Both returns will be submitted on 31st March 2026. Okay. The return for the year ended December 24 and period ended March 24 must be filed on this, D, delta. Okay. Linus died on 5th November 2024, having made a lifetime cash gift, lifetime, 6 lakh to a trust. We know that during the lifetime, when you make a gift to a trust, that is chargeable transfer, CLT. On 16 October 2020, the gift was made on 16 October 2023. Linus paid inheritance arising from this gift. So if donor pays IHT, it's 25%. If donor pays IHT, then it is. We know that when during the lifetime donor pays IHT, it is 25%. It is 25%. And we also know that that 25% is added to the gross chargeable amount. When donee pays, then it is 20% and it is not added to the chargeable amount. Okay, what examiner is asking, select the correct option. Will be responsible for paying additional IHT arising on the gift made to the trust as a result of. Okay, who will be responsible? Now listen. If Linus on Linus' death, who will be responsible to pay additional IHT? That is always donee. In case of trust, who is a donee? Trustees. Death tax is always paid by donee. Death tax is always paid by donee. And when it is due, death tax is paid on 6 months after the month of death. 6 months after the month of death. So Linus died on 5th November. So leave the month of November and then go 6 months forward. So we'll reach on 31st May 2025. So death tax is paid on 6 months after the month of end of death. And who pays death tax? That is donee. Here, donee is the trustees. By which date must Mouse House Limited notify HMRC if the first of its first accounting period? Mouse House Limited is a UK company that incorporated on December 2024. The company starts to trade on 1st Feb 2025. As soon as you start to trade, then within next 3 months, you have to inform HMRC. As soon as the company starts to trade, then within next 3 months, you have to notify HMRC. By which date must Mouse House Limited notify HMRC for its first accounting period? So from 1st Feb, if you go 3 months forward, Feb complete, March complete, April, so it's going to be from the start, within next 3 months, you have to inform HMRC. What is the total amount accessible to income tax for Blair in the tax year 24-25 in relation to furniture, heating, and lighting cost? Let's see. Blair has lived in a job-related accommodation. Stop. If someone lives in a job-related accommodation, number one, relating to accommodation, the rent benefit is exempt. Number one, you will not be getting any annual value benefit, any additional benefit. No, not at all. So relating to accommodation, the rent becomes exempt benefit, number one. Number two, what happens? Within that accommodation, if your employer is giving you ancillary services, obviously those ancillary services, they are your taxable benefit, but what do? We compare the ancillary services benefit with 10% of your employment income. Logically, whichever is lower, that is going to be your taxable benefit. To repeat, if your employer has given you the job-related accommodation, rent is exempt. Your employer has also given you the ancillary services within that accommodation. So we will compare the cost of those ancillary services which employer has given you. That is your benefit. But I have to compare with that 10% of your employment income. Whichever is lower, that will be your ancillary services benefit. Let's see. Blair has lived in the job-related accommodation provided by her employer for many years. She was provided with his accommodation on personal security due to the nature of the job. Blair has annual gross salary is 50,000 for the tax year 24-25. Her employer always pays for heating, cleaning, and lighting accommodation. Now, if the accommodation was not job related, then 7,000 would have been a taxable benefit. Straightforward. If accommodation was not a job-related accommodation, then this 7,000 would have been a straightforward taxable benefit. But this is not the case here. Her employer also provided Blair with the furniture on 6 April 24 at a cost of furniture. We know that taxable benefit is 20% of this, which is 2,000. Now listen. Ancillary services which employer is providing, one is 7,000, the second is 2,000. Logically, I will compare this 9,000 with the 10% of employment income, and within that employment income, I'm not going to consider this heating benefit and furniture benefit. So right now I've got only salary. I'll take the 10% of the salary, whichever is lower. So obviously 5,000 is lower, so I'll go for that. For example, if assuming heating, cleaning, lighting was just 700, assuming just 700, and my answer would have been only 2,700. So obviously then I would go for 2,700, whichever is lower. Just calculate ancillary services benefits separately, compare that with the 10% of employment income, whichever is lower, logically that is your benefit. How much input VAT in respect of office equipment can Freena reclaim on business VAT return for the quarter ended December 24? Okay, Farina commenced her sole trader business on 1st June 24 and registered for VAT from 1st October 24. The first return for her business for the quarter ended December 24. So first return is from 1st October 24 till December 24. During the period 1st June to December 24, the business incurred input VAT 110 per month in respect of hire of office equipment. So you are hiring office equipment means you are getting a services. Now listen. After registration 110 multiplied by 3. Let me use the calculator. That is 330. Now listen carefully. In case of services, those services on which you have paid the input VAT and you have taken those services just in previous 6 months before getting your business registered with the VAT authorities, then input VAT on those services which you have just taken in previous 6 months before getting your business registered with the VAT authorities, that input is also recoverable. So here, the business was started on 1st June 24. VAT registration was on 1st October 24. It means we can have maximum 4 months more from 1st June 24 till 1st October. If you count the time periods, a month of June, July, August, September. So basically, in case of services, if you have taken the services on which you have paid the input VAT, so all the input VAT which you have taken just in previous 6 months before the registration, that input VAT can be recoverable. That is recoverable. So 440. So the total is 770. What is the first year of for which boss or BAS Boomers Limited will be required to pay its corporation tax liability by quarterly installment? Now listen, large organizations, only the large organization, they are required to make payment in 4 equal installments, 4 equal quarterly installments. Large company is a company which is having augmented profit more than 1.5 million. But when you are having augmented profit of more than 1.5 million, you are a large company, number one. Number two, this 1.5 million augmented profit is for a 12 months chargeable accounting period, which means that if your chargeable accounting period is less than 12 months, so this 1.5 million will be time apportion. Number one more point. If you have got associated organizations within the group, associated companies means where your holding is more than 50%. Due to associated companies, this limit will also be apportioned. Repeat, if your accounting period, actually 1.5 million is for a 12 months accounting period. If your chargeable accounting period is less than 12 months, this limit will be apportioned. If you have got associated companies within the group, then this limit will be apportioned. Okay. Now, another very important point. If this is the first year of a company to be a large company, assuming ABC company is having augmented profit 2 million. Obviously, it is more than 1.5 million. Assuming ABC company is having augmented profit 2 million and let's say chargeable accounting period is 12 months, and assuming does not have any associated company, fine. If this is the first year of a company to be a large company, even though ABC company in my example is having augmented profit 2 million, but still they are not required to make corporation tax payment in 4 equal quarterly installments. Why? If it is your first year to be a large company, then logically your augmented profit must be more than 10 million pounds. If it is the first year of a company to be a large company, means previously you were not a large company, it is the first year your company has become a large company, it is the first year you have breached, you have crossed, you have exceeded the threshold of 1.5 million. If it is your first year, then your augmented profit must be more than 10 million. If your augmented profit is more than 10 million, then you are required to make payment in 4 equal quarterly installments. Keep that in your mind. And that 10 million limit is also for 12 months accounting period, plus if there is no associated company. If there are associated companies, 10 million limit will also be apportioned. BAS Boomers Limited commenced trading on 1st January 2023. It has always had one associated company. It means there are 2 companies in the group. Now for you, the augmented profit limit is not 1.5 million. For you, the augmented profit limit is 750. Logically, if your company exceeds 750, you will become a large company. But if it is your first year to be a large, then you will not only exceed 750, then technically you should be having profit more than 5 million. So if it is first year of a company to be a large company and your augmented profit is more than 5 million, why more than 5 million? Because there is one associated company always. One associated means one parent. There are two companies. So if it is your first year to be a company, if it is the first year, assuming that your company has become a large, then you have to actually exceed 5 million. Then you will be required to make corporation tax payment in 4 equal quarterly installments. Okay, year ended December, look at this 450. Can I say in December 23, not a large company? You're not exceeding 750. You're not a large company. You're not a large company. Now come here. December 24. Yes, a large company. Why large company? Because you are exceeding 750. But listen, even though December 24, you have become a large company, but this is your first year to be a large company. In December 24, you have crossed 750, but you have not exceeded 5 million. So it means December 24 is your first year to be a large company. Previously, you were not a large company. And in December 24, you have just exceeded 750. You have not exceeded 5 million. So in December 24, you are not required to make corporation tax payment in 4 equal installments. But yes, you have become a large in December 24. Year ended 25, yes, you are a large company because you have exceeded 750. Now listen, December 25, your company is a large company, and in the previous year, your company was also a large company. It means December 25 is not the first year to be a large company. Your company has become large in the previous year as well. So it means December 25 is the first year from where you are required to make corporation tax payment in 4 equal quarterly installments. Why December 25? Because December 25 is not the first year to be a large company. You were already a large in 24. But in 24, you met only one criteria. You exceeded 750, but you did not exceed 5 million. December 25 is not the first year to be. Okay, whenever it is the first year of a company to be a large company, and let's say there's no associated company, in that case, your augmented profit must be more than 10 million. But if you were previously a large company and in the current year you are also a large company, then if there is no associated company, I will compare your augmented profit only with 1.5 million. Here we are just comparing with 750 because there is one associated company as well. So December 25 is not the first year of a company to be a large company. It was large previously as well. So from December 25 onwards, you have to make, so this will be the first year where you will be required to make 4 quarterly equal installments of corporation tax. Okay. So students, that is all about pre-scene mock, June 25 tax, Finance Act 2024. We have discussed section A today, and tomorrow, inshallah, we'll be discussing section B. So thank you for coming for today's class. I hope to see you all in the next class.